Hey everyone, it's Imran from Options Insight. This is a quick message to let you know we've got our options trading bootcamp happening this weekend, 29th and 30th of April. If you're worried about the potential recession, this is the time you want to learn how to weatherproof your portfolio. Okay, who knows where the bottom is in this thing? 3,800 on the S&P, 3,200 on the S&P. There's multiple targets out there. In this bootcamp, I teach you how to hedge your portfolio. I teach you multiple techniques, whether it's long vol, short skew. These are things you need to know how to navigate market swings. So come and check us out at our website, optionsinsight.com. This is an opportunity you don't want to miss. I'm back. All right, what's been going on in macro land? Stocks lower yesterday. Regional bank concerns resurfacing. First Republic was down 50%. After the stock saw earnings and all that deposit flight that's been going on over there, so they're kind of done. Europe and China have been weak overnight as well. Poor earnings from industrials and things like that. Also, banking concerns spilling over into Europe a little bit. And then we've got Nasdaq, however, up 1% overnight because we had Google and Microsoft with earnings both beating. Google has been faded though in the post-market rally has been faded back down again. I think that was up 4% at one point, but it's now showing down, whereas Microsoft is still up around 7%. So NASDAQ futures showing slightly up still, but in general getting faded. And remember, we've got Meta tonight and we've got Amazon tomorrow. So those are going to be very, very key earnings reports and are kind of going to determine the fate of what the NASDAQ wants to do. But overall, broader market showing some weakness. Metals held firm, precious metals that is, whereas industrial commodities did roll over along with the general risk off that we saw. Volatility recovered strongly. See here, 3 vol uptick in US indices as S&P took out that 4,100 support level, got down to 4070. VIX had its best day in over a month, up over 2 vol points. Commodity vols were also broadly higher, but gold and nat gas vols were lagging compared to others that were up nearly 2 points. And if we look at carry, mostly green still, lots of green carry everywhere. And that's because implied vols are spiking as much, if not more, than realized vol right now. So that's going to keep the carry green. We would expect any rallies in spot to be finding vol sellers pretty quickly. When you've got this much green, you've got this much green carry, it's a question of people are just waiting to pounce on the vol now that the vol has spiked, but they just need to feel safe to do it. So they're waiting for the green light, and that green light will be some kind of rally back above 4,100. And they will smash the vol pretty fast, I imagine, okay, if that's what happens. Obviously, if we keep breaking to the downside, then it's a very different ball game. Okay, skew popping again. We saw another 1 vol increase in the S&P skew, taking it to the 66th percentile. So adding on to last week's gains. Clearly, the banking concerns are spooking some people here, along with the debt ceiling stuff. So, generally, investors looking for hedges again. Commodity skew was softer in precious metals, though, as the calls were a better bid as spot sells off. But then copper and oil seeing an uptick in skew, obviously, because they're more correlated to what's going on with the rest of the market. Okay, what else am I looking at? Risk reward looking poor for stocks. So once again, the CTA crowd, they've been adding length. We've been talking about that's partly responsible for why this market has kind of held up. CTA is buying back stocks as volatility's come down. Now, according to Goldman Sachs, who put out research on this pretty regularly, they're saying the profile for these guys is pretty asymmetric right now. So in a flat market, or flat to up market, they're small buyers, but in a down market, they're huge sellers. Okay, and that's from these lines down here saying they may have up to over $200 billion to sell in a down market, basically. Okay, so that's pretty frightening, the amount of volume that they would need to sell, and that would certainly have market impact on the downside. Now, there's no guarantee that we go lower, but basically saying if we go lower, let's say if we manage to get our head below 4,000. Then arguably there's a lot of selling to be done, and that could well precipitate a bigger move to the downside, and it could cascade due to positions being unwound. We think the S&P skew bid is partly reflecting this risk that people are seeing, and therefore, it's pushing it higher. Another interesting analysis from JP Morgan looks back at past recessions to try and ascertain what the kind of expectation of realized volatility should be around recessions, and then comparing that to where we currently are ahead of the recession that everyone is anticipating. Okay, so they're looking at cycles 500 days before and 500 days after a recession. They're basically saying currently we think we're something like 120 days before the recession is going to start. If we assume it's going to start in like 4 months, okay, which is kind of what people are thinking, around, you know, September time. And then if that's the case, where does volatility tend to be? So the red dotted line is your average realized vol over all the recessions. And it's saying that if we were to buy volatility here where the white line is, well, then look at where the red line is, right? The red line is pretty much going forward into the future, is above these levels of vol going forward. So essentially saying that owning equity volatility at these levels is looking attractive if we are at this point in this, if we think about this point in the cycle compared to all previous recessions, we should expect to see higher levels of realized volatility, basically. And this also backs up our view that we think the VIX got a bit oversold and was a bit of a purchase in the near term. But this also speaks to a bit more of a medium-term bid to the VIX and volatility, suggesting that, yeah, heading into Q3, Q4, we should expect to see higher levels of vol. Okay. Now, what else? We looking at China. Okay, so China stocks have been getting a bit battered lately. They've underperformed all the other equity markets. We see here FXI retesting these low levels that we reached in March, looking slightly oversold on the RSI here. We haven't seen a divergence. I tend to like to see a divergence on the RSI rather than just oversold, but we are retesting these levels. So, and we have been seeing the reopening coming through in macro data, but the stock market doesn't really seem to care. So a reminder that the stock market is not the economy, and is basically, it looks like the weakness in the stock market may be indicating something else in China, right? Obviously, we've seen a bit of a rollover in the liquidity in China, and maybe that's what's driving it. But the point being is, in the near term, we do look a bit oversold. There may be a reaction coming in China. And so we're thinking, are there ways to play a tactical bounce in China without getting too committed to that trade and investing too much or bleeding a load of carry on an expensive vol? Basically, that's the idea. Okay, looking at our dashboard, you know, we are seeing that vol in the front end at least has had an uptick. You can see that in the term structure going to inversion here. You can see this in the green line coming up here. So the back end stuff hasn't really moved yet, but the front end has popped a bit. Looking here, we're getting closer to the kind of bullish risk reversal in terms of what's being suggested by our strategy compass, but that does involve selling puts to buy calls. We're not really comfortable catching a falling knife and selling puts in China right now. We don't know where the bottom's going to be in China. China showed us last year, you know, that it can go down pretty, you know, violently. So I don't want to make any assumptions on how low this thing can go. So how would I kind of defensively look to play a tactical bounce? The volatility carry is still positive. Don't really want to buy outright calls in that condition. So what do? So I land on a call calendar structure. All right, so that's the trade idea from us for today. How to play a tactical bounce in China where it's looking pretty beaten up and pretty oversold without overcommitting. All right, cool. That's it for today. Thanks for listening. I'll catch you all tomorrow.